Good morning, ladies and gentlemen. As we just said, my name is Alagie Faye. At the moment, I work for BNY Mellon, and I'm a vice president of real estate and private equity. Previously, I've worked with Hudson Advisors Europe, where I work as an investment analyst. Within that, I do a lot of analyze most of our investment portfolios in terms of looking at the performance of those investments. We're talking about the IRRs and cash flows, valuations, acquisition price. But today, I just really want to talk about real estate and private equity, the overview, and what we're expecting within the next couple of years, and how the industry is doing. So, I'll go to my next slide. Right. This basically, we are expecting so much for private equity real estate in the next few years, and there will be private equity is basically rising, and there is so much demand in terms of investors, and in terms of investment managers are finding different challenges and trying to expand. Within these within the outlook, it's looking good, and everyone is expecting so much. Everyone is excited about this industry, but there are still challenges, and these challenges are one of these challenges that are going to be faced by most of the fund managers, the investment managers, valuation and fundraising. Basically, it depends on what region you are. Certain regions are basically majority of the investment managers, especially the top investment managers in terms of, we're talking about Goldman Sachs, the likes of JP Morgan, Hudson Advisors themselves find valuation more challenging than anything else. In the other side of the region, we're talking about Asia and Africa investment managers are finding fundraising more challenging. If you look there, you can see that there was a recent survey done, and 70% of LPs and 40% of GPs find valuation more challenging, and that's basically looking at the portfolios, trying to value these portfolios, and finding that very challenging. Fundraising also extremely challenging. But it's mainly to do with the likes of the lower investment managers that are just starting, for the likes of the ones that are like have their first fund going to their second fund. So the biggest challenge they find there is to raise fund, because your fund is really your investment company, or as an investment manager, your investment firm is really as good as your last investment. So you have to be very positive and trying to give returns to investors to be able to get more investment in the long run. So just the next slide here is just to kind of talk about the differences between the private capital and private equity. So there's a differences between this private capital and private equity asset class. So with this, I'm just gonna kind of have a quick look at this closed-ended private capital, where you can see that there's a lot of you can see the private equity here, where it's more typical, your typical PE, where you got your buyout, your venture capitals, where they specifically invest and go in and buy do a LPO and buy a full, like the whole company. And then the rest is just your real estate, your private debt, your infrastructure and resources. And this slide is just to see the differences between the private equity and the rest. Between the private capital, you have the much broad and spectrum of the whole asset class. So this here is just a key figures between PE and private capital. And if you can see, just private capital alone, last year, as of 2015, we are looking at 2 trillion of asset under management just last year alone, and then 551 billion worth of capital funds. Then compare that to PE, which is more your typical buyout, as I said before, compared to your more spectrum, more broader private capital. You're talking about 2.4 billion asset under management in 2015, and then you're talking about 189 distribution made in 2015. And then compare that, you're looking at your typical PE buyout. So you have over 411 billion of buyout deals made last year compared to your normal venture capitals. So your venture capitals are your normal, where they just go in and buy shares within startup companies, and maybe most of the time they're buying within up to 50% of shares within these startup companies. Your normal typical will just go in and buy the whole company. Restructure the company. Normally there'll be more non-performance companies that are struggling, where PEs will go in and buy the whole company, restructure them, change management, and then take up from there. So as you can see, that you got there's a big difference in terms of numbers. So despite all the challenges they are facing in terms of the fund manager side, there's so much pressure within the fund managers, and they are now facing a lot of challenges, and they are trying to focus on outsourcing. And as of today, we have so much. There's so much outsourcing going on still. Where if you look at the graph, the majority of these fund managers are outsourcing most of their fund accounting, their custody, financial reporting, they are outsourcing their TA and others. And to be honest, with the pressure on them to perform, to deliver what they've been promising to these investors in a quarterly manner, in a monthly manner, they are on so much pressure, and review and report shows that in the long run they will be actually be outsourcing even more. We're talking about them outsourcing more the likes of compliance. They will be outsourcing their KYC processes. They will be outsourcing their ITs. They will be outsourcing the likes of internal audits and so on. So they find it so challenging, and then as a fund manager or as a custody, you are expecting these investment managers or the investment firms to be outsourcing majority of their services. So there's a more demand as a custodian or as a fund servicer going forward in the long run. This is basically a slide that I just put through. It's actually basically took it from a BP, a business plan that was made for an investment purpose. But the only reason why I have this here is just to look at it and see what's really driving this industry, what's driving private equity. Why it's getting so popular, why there's so much demand in it. To be honest, the main thing of this is just the incentives. There is so much attractive incentive. There's so much incentive within the fund managers to be able to go out there and perform. So looking at this is one of the investment objectives. Majority of these fund managers now are offering an IRR return of about 20 to 25% of a return, which is very attractive in terms of the investor side of things. Then in terms of the fund managers, you have their incentive where they also have your typical, let's say, distribution, where you have your we call it 4-step waterfall. So within this distribution is where majority of the incentive lies within the fund manager. So you're talking about, okay, giving a return of 8% preference per annum for the investors until they return 100% of their capital invested. Then from there you're talking about 80% to the LPs and then 20% to the GPs. So there is so much, like for instance, if you are getting a fund size of about 500 million, at the end of the day you made a profit, let's say, of 20%. 100%, 80% of the 20 is actually going back to the fund manager's pocket. So there is so much incentive for them to perform, and that's why this industry is just going to keep going up and up, and it's going to be excited. On top of that, on top of the incentive and everything else, majority of this capital they are getting from investors or refinancing. At the end of the day, they're still gonna use every one of those to invest within to fund their fees and expenses. So on top of that, this slide here I just highlighted, the managers are entitled of 1% of acquisition fees and 2% of disposition fees. This is common, and it happens to especially the bigger fund managers or private equity firms, where if you end up acquiring a property or NPL, non-performing loans for 500 million, like I saw earlier, 1% of that is going directly to the fund managers, 2% is when you dispose of that. So there is so much available in their disposal once they performed. Right, this is basically fund manager side of things, of the outlook of what was basically the outlook of 2015. So if you look at the graph here, we are looking at North America, Europe, Asia, and rest of the world. And I think rest of the world is mainly covered in terms of Africa. And if you look at the green there is significantly more capital than 2015. So this is what's been expecting. So we are saying that 2015 there will be more capital available for the likes of Africa to invest within this industry, and it's just gonna get it. It's just gonna be. It's just gonna improve. Despite that, every other region has improved from 2015. So there is so much demand within PE going forward. Right, this is just a slide I get from Enterprise Island, just to show how much funds are available within the industry, and this is just Ireland alone. We're talking about if you look at the UK, if you look at the rest of Europe, there is so much funding available for PE, venture capitals, and startup companies. So I mean, there is so much demand, and this is just absolutely nothing compared to what's out of Europe and others in terms of North America and so on. Right. Thank you very much.